Welcome to the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kieran Cavanna. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors podcast. I'm your host, Kieran Cavanna, CIO of Old Farm Partners. Our goal is to bring you some great investors and themes they are working on. Some are under the radar, and we think all are experts in their discipline. Today, we have a great fund in the hidden gem category called PlusTick Partners. They have a seldom seen style of investing. It's been around for a while, and they are great practitioners of it. And I think people will find it very interesting. It's run by the dynamic duo of Tommy Hill and Adrian Keevil in the great city of Charlottesville, Virginia. Welcome, Tommy and Adrian.
Thank you.
Thank you. Can I say I'm a big fan of the show?
Yeah, sure, you can, for sure.
And also honored to be on the same podcast that featured someone who may or may not become the Treasury Secretary.
Well, by the time people listen to this, we'll know. So real quick about PlusTick, they're an opportunistic multi-asset investment firm. They invest in equity and credit and look for distressed situations where they can have big potential outcomes. Tommy is an experienced hand, has been risk-taking seat for decades, seeing multiple cycles of distressed. Adrian, similar experience, has a PhD from the Darden School at the University of Virginia, where he teaches a class. Well, fellas, we could go in a number of directions, but I thought to kick it off, we could just talk about your backgrounds and how you got to this seat that you're sitting in today.
Great. Well, this is Tommy Hill, and I'll start off very briefly. I ran a paper route when I was a kid and started buying a few shares of stocks when I was 12 or 13 back in the old days, and made some dough, and went on to become a stockbroker. And then in the late 80s, saw that there was a fellow at the office of Hambrecht and Quist where I was working that was running a hedge fund, and put that in the back of my mind. And in 1990, I started a hedge fund with my partner boss, George Putnam, that was focused on distressed investing. And we started with a couple $1 million in 1990, and we compounded over the next 22 years at a pretty good number and grew the firm fairly large. And so I've been doing it since about then, and then left in 2012 really to pursue my particular strategy in investing, which was concentration and hanging on to securities for a reasonable amount of time, and tried to identify someone that could come and help me in this particular way. And came across Adrian Keevil, who was finishing up his PhD at the University of Virginia, and his focus of his PhD work was on stakeholder theory, and he put a lot of language to the investment theories that I was kicking around. So that's how the two of us got together.
And my story is, my dad is an investment banker. He's one of those rare people who loves the work and is still doing it. And when I was in college, I wanted to go into finance, and he advised me not to do investment banking, but to go work for a company in corporate finance. So I did that and went to work for a company that called Young and Rubicam. Ended up working for the chairman. We did a recap with Hellman and Friedman. The company went public, and then within a couple of years, it was acquired by its largest competitor. And I was totally hooked on the idea of these sort of big winner type investments. I went to business school and then figured I'd get the keys to the kingdom. And when I came out, I realized that a lot of those theories that they taught me don't actually hold in practice. I met an economist called Roland Fryer back in the days before behavioral economics was actually a field. he got me hooked on that. I went back for my PhD to try and get the keys to the kingdom the second time around. And as Tommy said, I met Tommy towards the end of that process. I was going to be a professor and use my research to inform my investing. And he convinced me to use my research to inform investing and do a little teaching on the side. And so that's what we do.
Well, it's great. I mean, rare do you find a partnership that lasts over a decade. You guys have done a great job. I'd love to talk about your style. I mean, it's one of the more interesting strategies out there. You guys look for big potential outcomes. So maybe give us a sense of what you look for. I mean,
sure. So what we're really trying to find are doubles and triples, and over an 18-month, 2-year period of time. And we're really trying to ring the register, understanding that we make plenty of mistakes along the way. And that's really how we're trying to look at a position when we take it on, is we're looking for big moves. And so we have a reasonable amount of volatility in the portfolio, as you know, Kieran, and hopefully we have good volatility.
upside vol.
Yes.
Upside vol, yeah.
Adrian, what else do you guys, where does that lead you? Like what kind of industries? I know over time, oil and gas.
We call ourselves a distressed fund, which is, I think we'll get to this at some point about sort of how the industry classifies different firms. But, what we really like about distress, and Tommy comes from a distressed background. I would say I come from a high yield background. And what we really love about distress is that you have these situations where there's market panic, something really bad happened. Maybe there's an ethical scandal, or maybe a new entrant into an industry sort of disrupts the industry, and securities sell off aggressively. Stock goes from 100 to 10 or whatever. Bonds, potentially, if there's financial distress, the bonds will go from par to 40s. And when that happens, in our view at least, that there's sort of a period of time where something is effectively left for dead. It's either tainted, or people just don't want to talk about it. Lots of people lost money. There's deal fatigue, all these other things that are perfectly rational. And if we look through those, the rubble of those situations, sometimes we can find hard evidence that suggests that the situation is much better than what the market price implied narrative is. And so those are the types of things we're trying to find. As Thomas said, we might not always be correct, but when you find something like that and you get it right, obviously you can have a significant multi-bagger type return in either credit or equity securities. And
I'll dovetail on that. You mentioned oil and gas. One of the ones that has worked, and then it shows some of the pitfalls of how we invest, is we bought the Antero Resources bonds in the early 20s and 2020s. We paid in the high 40s, maybe 50 cents on the dollar for those bonds, when the stock was trading at about $0.75. We bought the bonds. They ran up into the 70s. We took a look at the stock. We were convinced that the company was going to be able to limp along. We ended up buying the stock at $1.75 to $2.25, somewhere in that range. And I think we've averaged it up a little bit since. The stock then ran up from there to the mid 40s. So that's the good news. The bad news is we forgot to sell. We've sold some stock along the way, but I wish I'd sold all of it in the position there. And we sort of had to wait for the next couple of years, where the stock rolled on down to the 20s and is now, in my mind, looks like things are coming together on a very opportunistic way with the gas situation. It's a gas supplier based in the Marcellus and the Utica.
I mean, it's the kind, and that was a huge win. And I've had other ones like Clayton Williams a long time ago. But but I guess when you invest in those kind of situations, you have to be prepared for the inevitable downside when you're wrong, right? And I've seen some of the names down 80, 90%. Just luckily, you guys have had these 10 baggers over time that have really, I think maybe Adrian says, you masked a bunch of mistakes, right? But over time, you make, it's a hit rate business.
Yes.
Yeah, and there's a wisdom to that. When Tommy and I first met, and he talked about how he wanted to structure the portfolio, I thought it was like somewhat different compared to the way a lot of people run portfolios. And he was thinking about, if we have 20 positions, each are sized around 5%, hopefully you have a few big winners. You have some that sort of are singles and doubles, and then, you're insulated against your inevitable mistakes. And whether those are, down 50s or more potentially, you want to avoid those. You don't want to have those. But that's, it's a little bit more, I would say, how some people loosely talk about venture capital and the way they structure their portfolios, but we're not just swinging the bat all the time. We're trying to not make mistakes.
Correct. Yes.
Right. You're looking for a catalyst, right, to change whatever the current situation, right?
That's right.
Right. And why don't you mention the Embark bonds, which we've recently bought, which are trading in the mid 40 cents on the dollar right now. And you can just touch on that, Adrian, about what we're seeing there. And it sort of relates to the AI securities, that it dovetails into the AI securities that have really helped us. And all these AI securities that we own are either many have recently emerged from bankruptcy of all things and have just crushed it.
I think it's early in the show to start talking our book, but I'm happy to do it.
Okay.
How
about it?
Yeah, Embark, and this is Thematic Investors. So I know, Kieran, that a lot of your guests have themes. We also have themes. I think our themes typically emerge from the bottom up. So if we invest in something, we learn a lot about it, learn about the industry, and then all of a sudden we start to have a view on sort of other adjacent securities. Last year, in the spring, maybe it was early summer, we invested in a company called Talent Energy, which was at the time coming out of bankruptcy. We do bankruptcy. We served on committees. Tommy's gone through long court cases the last years and years and years. We don't love to do that. It's not that efficient. So we've adopted a position of sort of waiting for the plan to be confirmed, and then assuming we like where the securities are trading, get in at the end of the process. But Talon was a way over levered independent power producer. They had some gas peaker plants and a big nuke plant. It went bankrupt. The capital structure got flushed. The stock came out, and all of a sudden, demand for power started going through the roof. They cut a deal with Amazon to sell a bunch of capacity at the nuke plant. And, this sort of long shot potential for AI started becoming actually very real on the ground. And that, led us to a bunch of other investments that are sort of similarly distressed and overlooked at the time, that have had massive upticks in their businesses. Embark is one. It's a little bit of a I would say, departure from that theme, but not completely. It's a very long story how Embark. It's actually the DBA is Brightspeed. Embark has been a part of 3 or 4 different companies over the years. The most recent, which is Brightspeed, which is a sponsor-backed company. Apollo is the sponsor. They are going to invest a lot of capital in upgrading what are now copper wires into the home and replacing it with fiber. Similar sort of playbook to what was executed at Frontier recently, successfully. But the bonds are trading at 40 cents on the dollar. The company's well capitalized. Relatively
They did a huge recap this summer, flushing some bonds completely, and with a major capital infusion from Apollo.
Yeah, and we don't have any inside view on what Apollo's thinking about the deal. It's a fresh deal. We like sponsor-backed companies that are sort of new in the portfolio. They still care. And the thing we own is a small legacy piece of paper in a massive capital structure, where we think that there's a decent chance that they're successful. The company gets acquired, and we receive par for the paper, or that if it limps for a few years, we'll clip a nice coupon along the way.
I'd love to. I want to get more into telecom later, but yeah, I'd love to talk about just going between equity and credit. I mean, there are funds that do that, but the vast majority really stay in their silo. They're either credit only or equity only. You talk about why it's an advantage. I mean, I think it is. I see it with you guys, but maybe you could talk a little bit about that.
Absolutely. Do you want to start, Tom?
Sure. Well, I think the Antero is a good example of how we can ring the register when we do the work on the credit side and see that the risk is that a company is becoming de-risked for whatever reason, whether the market moved against us or otherwise, that influences us and enables us to look at look at the equity going forward. I'm trying to, several of the names that we own in the portfolio are formerly distressed bonds that have been equitized. And that's been, as many of your listeners will know, there's been very little distress over the past 6 or 8 years. And so what we were looking for, companies that have emerged from bankruptcy or have emerged from distress or have been recapped prior to a bankrupt situation, prior to a bankruptcy, and then taking a look at the equity and then letting it rip. Or and I'll hand it over to you, Adrian, from there.
I mean, like the nerdy answer, is that if you look at, if we like a situation, if we like a company and we think it's going to do well, and it's the market's perceiving it that it's not going to do well, the whole capital structure gives you a menu of various risk reward scenarios, all the way from the top of the capital structure to the bottom, and we can toggle our tolerance for risk accordingly. So like as we talked about with AR, we can buy the bonds and a little bit of stock, or potentially if it was riskier situation, a term loan that's yielding 15% plus a little bit of the bonds and a little bit of stock, or some other scenarios like if we like an equity and it has a convert potentially that's yielding real cash interest, and it's close to in the money, you can buy the convert and it behaves like the equity on the way up, but on the way down you've got some risk protection because there's cash interest, and assuming it's not going bankrupt, it'll trade to an appropriate yield. And so there are all sorts of interesting things you can do creatively if you have a sort of a credit and equity mindset. And I think also approaching everything from a credit perspective as a discipline is useful, because it means that we're looking for assets, we're looking for cash flow, we're looking at the sort of the basics of the business, and hopefully not getting too carried away with things that really aren't, I would say, good metrics from which to glean.
And I also think that sometimes, in your case, you guys often end up that you buying the equity as the most levered piece of the cap structure.
Yeah.
And many other distressed investors, the big ones typically, they love PG&E, but then they just buy the bonds and hope they go back to par. I mean, for you guys, it gives you quite a bit of leverage.
Yeah, I'd agree. And the risk reward, we're trying to optimize for risk reward. We're trying to find scenarios. And again, we might not always be right, but we're trying to find where the place where, you're hopefully covered with some assets, and maximum pessimism is sort of implying the price. And if you're buying a bond at 85 cents on the dollar in a company that has equity, if you buy that bond and everything works, your return is, I don't know, 20% or something like that. If you buy the equity, you're getting like a 3 or 4 bagger, maybe a 10 bagger. But if you're buying an unsecured bond that's trading at 85 cents, you're still taking equity risk. You just have capped upside, in our view.
And there's also you might want to talk a little bit about CommScope and how
that's a great idea.
We were short the CommScope bonds. They made a sale. I was too late on covering the short. The bonds ran from the 40s up into the 60s, but we did cover. And in the meantime, Adrian had done a bunch of research to look into the situation as what was going on with the change of the division that was being sold. And I'll hand it over to you.
Yeah, I mean, it's a perfect example. So we'll sometimes go short something and then toggle and go long it because we know the situation. If the situation changes, then it makes sense to.
What does CommScope do?
CommScope is a highly levered loosely defined as telecommunications equipment manufacturer and distributor, and so they make everything from radios to fiber cables. So it's large parts of its business are commoditized, other parts are a little bit more specialized. It's tied directly to telecom capex and ... not surprisingly, data centers. And so when we noticed we noticed a complete turnaround in one part of the business and decided to go long the stock. And they supply basically everything you need to connect the equipment inside of a data center, including like the cabinets and the racks. Some of that I think is priced in. A lot of it isn't. And they have these other businesses that supply to telecom industry. Telecom industry has been in a sort of a bear market from a capex perspective for the last few years. If that turns, then CommScope should really crush it. There's some
But you want to talk
complications.
about the sale of the division that
Yeah,
recapped it?
They sold the division for $2 billion, which took bankruptcy off the table. There's, they've got a maturity wall coming up, one maturity next year, some big ones in 26. That sale raised a couple $1 billion, which we believe takes bankruptcy off the table. And now they're in negotiations with creditors to do a sort of more wholesale restructuring of the balance sheet. There was an ad hoc group that approached them. They did not come to an agreement. Our sense of that is it was CommScope driving that decision. And so now they're going to the broader creditors, and we think there's a deal to be done.
One of the reasons I want to talk to you guys actually is because this is a good dovetail into your opportunity set right now, because it seems to me that AI and power and infrastructure is a huge focus for you guys, and you really have the skill set to evaluate it. And CommScope's probably part of that story, but maybe you could just talk about what you're seeing today. It seems like a pretty target-rich environment for what you guys do.
I'll jump in real quick and just it's almost accidental seeing these companies like Core Scientific or CommScope or that come in and have been in deep distress, and all of a sudden the world has changed. And as you know, Kieran, and everyone has read, I think the numbers, the amount of CapEx that's going into AI and Talon and APLD. I mean, the amount of CapEx that's going into AI is astonishing.
It's mind-boggling.
And so I'll hand it over to Adrian just to talk about an APLD, or we've already talked about Talon and CommScope, but these companies were all on the edge or were in bankruptcy and have emerged from bankruptcy in the past 18 months.
It's kind of what makes distress so much fun, because Core Scientific, another company, was bankrupt. I think it emerged this January. It went bankrupt because it couldn't pay a $54 million maturity. And this year, since it's emerged from bankruptcy, it's signed, I think, about $8.7 billion of revenue contracts.
Wow. $8.7 billion.
Wow. That's real cash money. That's not that's not bookings or any of that other stuff. That's real revenue. And that's what you can find. That's if at its best, those are such opportunities that distress provides. And another one, Applied Digital, is a company we really like. They started as a Bitcoin miner, and then they were going to do normal data centers, and then all of a sudden AI came out, and they decided to do AI data centers. And I think the assets that they have really are these power contracts. They've optioned power from reliable providers at low rates and in massive quantities, hundreds of megawatts that are hugely valuable. And I think that they're going to do really well. And
they have a situation up in the Dakotas where there's a lot of stranded power, and we've pivoted even to buy the power company up there, MDU Resources, and are involved in a spinoff that they just made which looks extremely attractive. But you might want to talk about APLD and
absolutely
what's going on up there.
One of the things that we've learned from APLD was this idea of stranded power being valuable. There's a huge wind farm in North Dakota that supplies this data center that they're building. And there's basically no one that lives there. So they have this 1.2 gigawatt plant that's, essentially generating electricity for nobody. And so we were sort of curious in what other places in the country did that dynamic exist. We live in Virginia, as Kieran mentioned. It doesn't exist here. There's an enormous amount of data center demand. I think it's 35% of the state's demand is going to data centers. So this is a congested market. But a place like North Dakota, where you have a lot of space, you have generally friendly regulators, and you've got a nice cool climate, which means that it's a little bit more efficient to cool the system. You can put a lot of data centers up there. And so we got interested in MDU, which is the power company that's supplying power to Applied. And this deal that they're hopefully going to do in APLD in North Dakota it's up to 400 megawatts of power, which is which should have a major impact on MDU's earnings. And by the way, they've got a lot of their capacity up there that's underutilized, and they also they transport half of the gas that's generated in the shales up there in the Bakken.
Right.
And what we have, one of the things we like to do is talk to people who are actually in the business, who are doing the stuff. We've got Tommy's invested in solar personally over the years, and we've got good relationships in that industry. And the thing we kept on hearing from people was that the big bottleneck was infrastructure. It's not that surprising. Like the power transmission capacity is a bottleneck. Well, it just so happened that MDU was spinning out a company that does electronic construction. So they do high tension, all the way from high tension power lines to really intricate, complicated wirings like the Sphere in Las Vegas. It's a nationally based company. We think that there's a huge tailwind behind that. And you also have a nice dynamic of a spin, which typically can produce opportunities. So what's left is MDU Resources, which is a regulated utility, and a construction company called Everus, which we think both are undervalued.
But you might want to talk a little bit about APLD and what the opportunity set is there in terms of the potential for a major contract.
Yep. And so APLD, I kind of gave the background a few minutes ago, but we think the big change with this business is hopefully imminently, and it's been imminent for the last 6 months. So take it with a grain of salt. But they're in contract negotiations with a major hyperscaler to produce a building that they've actually already, I would say, probably halfway or maybe 2/3 of the way constructed on their own dime, by literally borrowing from anybody who will lend them money. But this transaction could generate as much as $400 million of EBITDA annually, and would be a significant change for a company that we think the market gives very little credit to. And by the way, this thing would be eventually 400 megawatts. They've got a 1.2 or 1.3 gigawatts of power backlog that they could also sell. We think it was de-risked earlier this year, maybe a month or two ago, when NVIDIA and Related participated in an equity offering. We think that's significant. First of all, we know they did a lot of diligence. Second of all, Related obviously is one of the largest real estate development companies in the country. They've got a huge push on data centers. Their CEO is on record saying that he thinks data centers are the most attractive real estate opportunity of his career. NVIDIA needs no introduction, but we think it's worth noting that NVIDIA, I think contrary to what most people believe, has been very selective on its investments. It hasn't made many of them, and it's made at least one other investment in the what we call the infrastructure space in CoreWeave. CoreWeave, valuation is astronomical. We think that NVIDIA has the ability, should it choose to, effectuate outcomes in the industry. And so we think those, in addition to this hyperscaler, which we have a view on who it is, we won't say who we think it is. If that gets revealed, I think then, the future of APLD is much different than what the market's implying currently.
And guys, I think it's a great example of what you do and how it leads to your next investment, and how it's a little complex. There's equity raises, there's cap structure. I mean, we usually say at the top, this is not investment advice. So because this is still high risk stuff, and
absolutely
something can go wrong, and they're heavy CapEx stories with big cap structures, and that's your job. You guys are professionals, and you guys are assessing these situations, and they don't always work. Although you're on a very good run lately. Maybe we could switch to telecom for a minute, because I think you guys have particular great experience in that area. And maybe you could talk about what you see there. Another CapEx heavy industry, lots of problems, but lots of residual equity raises. I knew you were kicking yourself when you saw Lumen go up, because you guys had looked at it, didn't buy it, and then the thing quadrupled. But maybe something like Globalstar might be interesting, just because Apple made a big investment in Globalstar recently.
Correct. Yes. And I'll kick it off again. Just we've had a reasonable amount of success dating back, back in the old days at New Generation, back on some of the wireless cable names back in the late 90s. And out of that actually came a company called Windstar that went bankrupt and was bought out of bankruptcy by IDT and spun out into a company called Straight Path. And this was in the early.
Oh yeah,
it was bought
that's
in
right.
in 2009, I believe, and spun out in 2013-14 timeframe and publicly listed. And they owned a big slice of spectrum that because of what Adrian saw coming, which was 5G, we thought would be extremely valuable over time to the telecom industry. And so one thing led to another, including a bear raid, a short sale bear raid that took the stock from what we bought originally at 14, from 14 to 50 back to 8, and scared the pants off of us. But we stayed with it because we had pretty good understanding of who was running the business and who was on the board, and that they were quality people. And so we stayed with the name, and one thing led to another, and there was the spectrum ended. The company ended up selling out to Verizon in a bidding war with AT&T. That the bidding started at 92 to 105 to 130, and then Verizon took it at 170, $180 a share. That helped validate our thesis that there's a lot of very valuable spectrum out there. On the other side, we've owned something called Global Star for about 10 or 11 years prior to the Straight Path stock purchase. And for a while it did well. Sadly, it's floundered for years and years and years. We stayed with it a little bit too long, but it looks like it may be coming to fruition. That and something called NextNav that we own also. It's our biggest position in the portfolio, that has got a slug of spectrum that we think is very valuable, and also an alternative to GPS. And Adrian, I'll hand it off to you since
Yeah, maybe talk about NextNav if you don't mind, because
Yeah.
little obscure.
Yeah, it's we a lot of our stuff is obscure, and NextNav is a company that was venture backed. It had a software essentially that was a radio version of GPS that could do two things. It could serve as a backup to GPS if there was some kind of a GPS outage, and it also had in it a vertical positioning ability, so that if you were a first responder in a city and someone has a medical emergency and they call 911 and then they pass out, let's say hypothetically, the first responders currently know where that person would be on a horizontal plane, but they don't know what floor the person would be on. And so this, one of the other benefits is this technology allows first responders to know where people are on a vertical plane as well. So, but in addition, they have what we think is a very valuable piece of low frequency spectrum that that's currently involved in an FCC process. We don't want to comment on how we think, what the FCC should or shouldn't do, but we think the company has a really good argument because it's going to provide a service that's beneficial to the country in this backup GPS system, essentially for free, if it's allowed to sublease its radio spectrum to a
This was a
provider.
SPAC, wasn't it?
It was
originally?
a SPAC. Yep, it's SPAC. It was in the golden era of SPACs. We had the good fortune of not participating in the SPAC and waiting. Like most SPACs, it didn't perform that well out of the gate. I don't want to.
Stock went from 10 to below $2. So it was a difficult situation.
But we think, and again, this is not investment advice, and we make plenty of mistakes.
Yeah.
Be clear about that. But we think this is an excellent management team. We think that they're really providing value to the American public, and we think that investors should have a decent return also.
And there is an incentive. There is an incentive for the U.S. government to have a backup GPS system we've all been reading about the spoofing of GPS that's been going on with North Korea, even last week, and also with the Russians this past summer. So there are some real national security issues that potentially NextAv can help solve.
I'd love to shift a little because, I don't hear these kinds of names, and I just, with many other hedge funds, and I just want to get your perspective on ever since I've known you guys, you've had 5 people or less at your firm. You work on things together, and you're in Charlottesville. You're obviously not in Midtown Manhattan. You're away from a lot of stuff, and I wonder if you just think there's an advantage to that, and not having an army of analysts where, why would they go through the SPAC world to find a $2 stock that could be 10x? But maybe they do, but I just never hear it. But what do you think about the culture?
Well, I think I'll just jump in. I think there are advantages and disadvantages. Be realistic. I mean, there's some guys many guys are in New York are in the flow of interesting things that we miss out on. On the other hand, we don't participate in some of the noise that can get us confused. And I think that we assume it helps to our benefit. It works to our benefit. That there's no particular disadvantage or advantage being here is what I would say. I like to think there is an advantage, but I don't want to underestimate that there are plenty of smart guys in New York that are doing a lot of very interesting things. So that would be my understanding anyway from my years in the business. So one thing we try to do is stay as close to as many people in the flow of our names, regardless of whether they're in Los Angeles or in New York or in Connecticut, where there are a lot of the names are getting kicked around, and I think we have pretty good information flows via the phone, really, all on the buy side and sell side. I'll hand it over to you, Adrian.
Yeah, I mean, we got started. I remember Tommy had a huge Rolodex on his desk.
Literally
digital,
Rolodex.
But, literally a Rolodex, and we would work that thing all day long. And it's always been the principle here to use the phone as much as possible to avoid, just falling in the trap of Bloomberging or emailing people, because, a lot happens in those conversations. And I've been around, Tommy a long time, and he's got this really great technique of getting good ideas from folks just through having conversations and asking questions. What are you working on? What's interesting? What's that weird guy that we met last time? What's he working on? What's the craziest, riskiest thing you've heard someone pitch you recently? All these questions, and 9 times out of 10, it yields an idea. That idea might be terrible. It might be the worst idea ever, or it might not be. But the point is that you get something that you wouldn't have gotten if you just are reading the reports or just sort of like, talking to them casually. And I think the other principle that Tommy stresses that, I've adopted, and so it's, sort of the MO of the firm is to give as much as you get. And so when we're talking to a research analyst about a name, if we get interested in it and we start doing research, we'll share all our work with those folks, and they're on the front lines. They're trying to pitch ideas to clients. It's their currency. And so the point is that comes back to us. They'll call us when they have an idea that they're working on and they want our view on it. And I think so that having a more relational view has been really helpful. And we'll generate our own ideas, but a lot of our ideas come from these relationships.
Oh yeah.
But I mean, and that's a great way, because I was going to ask about sourcing. I know, Tommy, you've got some deep roots in many firms I've never heard of on the sell side, that you know these guys forever and what's going on in distress. But you guys are definitely rooted in fundamental investing. That's the big, because there are a lot of people who source that way and they sort of trade their personal accounts in a way like, oh, this is interesting and big upside, and they don't do anything. But you guys are building models constantly, right? And I mean, and how important is that to kind of hear a great idea qualitatively and then quantitatively back it up with a great model?
Yeah, it's not only, it's really a whole bunch of other things also. Like we're gonna go really deep in terms understanding how the business works. We're gonna read we're gonna read trade journals. We're gonna talk to as many people as we can who are in the business. We're gonna look at litigation cases. We're gonna
look at Glassdoor.
And try and get a sense for how this business operates, who are the key stakeholders, what's the most important variable in this working or not, and then we're going to devote a lot of attention to try and figure out that variable, or maybe sometimes two variables.
Yeah, I mean, and maybe I could shift a little more because you guys actually short stuff. I mean, you don't use a lot of leverage, right? And you have a pretty concentrated book, but you short things. I mean, Tommy, I think you were one of the few people I've met in the world that short WeWork bonds. So can you talk a little bit about shorting bonds and equities, and how it works for your firm and the outcome?
Sure. Yeah. First off, we don't use any leverage. I mean, we can be 100% long and 50% short. So in the grand scheme of things, I guess we do use leverage. We're not we're never more than 100% long. So that's that. Yeah. On the short side, what we started shorting at the old shop and on shorting bonds in the late 90s as opposed to equities, because the asymmetric risk profile of shorting a bond in the 80s or 90s is works in our favor. And we had, in those days, we had several high coupon cash pay bonds in the 80s and 90s that went to the single digit midgets, so with those, that's the kind of thing that we ideally like. The markets are a little bit more efficient on those things, at least we think, but we really like shorting bonds right now. And we're short. Can we talk about the names that we're short at all, or? And
maybe just some industries you're in.
Yeah, we're short some satellite companies, a satellite company, I should say, and that we think has a short runway, and we're short the equity, short the bonds. The equity has been volatile, but it's coming our way, and it's gone our way in a big way. And although the position is relatively small.
And I guess being like, having that skill set in credit really helps, right?
Yeah,
I mean, I know you're not involved with Spirit Air, but I've been watching that, and a lot of equity guys bought it at the very low value, single digit midget, as you say, Tommy, and it looks like they're going the way of bankruptcy, and and I know you guys were not involved in it, but I think the credit guys that I knew were not embracing that there was a real pathway out for these guys. Is that fair?
Yes, I think that's fair. And there was so much noise circling around that. We decided to stay away from that. It was so hard for us to figure out what the government was going to do, what Frontier was going to do, and another airline was going to do. So we just didn't have a dog in that fight. So we let that one slip by. But the larger point is where we see a distressed situation. Now, it hasn't been fruitful for us to short distress over the past 2 or 3 years after ringing the register for every year on the short side on fixed income. But it hadn't hurt us, but it's not been a profitable area. I think that might change, and perhaps we need to be a little bit more selective and a little bit smarter on some of our names. Many of these companies that should have been put out of the misery have gotten an additional equity infusion or fixed income, and a refi somehow, and bailed out the bonds that we were short. So there was so much private capital kicking around that we didn't necessarily see was going to bail out some of these companies that we were short, and that has hurt us.
Cool. Yep. Maybe I can't let this go because your partner, Tommy, has a PhD in stakeholder theory, which I'm still trying to figure out exactly what that is. But maybe you could define it for us quickly, Adrian, and how does it pertain to what you and Tommy do?
All right, great. Well, stakeholder theory was developed by a guy named Ed Freeman, who's at the Darden School here at the University of Virginia. And the basic idea is that most theories that inform finance and strategy and all business school disciplines are predicated on this idea of the company as a corpus, as a corporation, metaphorically a sort of airtight thing where there's a bunch of employees in a building and some factories or whatever. But if you look at how business actually works in the 21st century, it doesn't work like that anymore. There are customers, suppliers, regulators, communities, employees, all these groups of people that have a huge impact on the success of a business. And so the general idea in the PhD work was to to take that framework for thinking about a business and use it as a way to think about a business on a pro forma basis to try and predict how it's going to be in the future. And then the second piece of it is that a lot of theories that inform finance and investing are based on the idea of economic rationality, and that is a useful thing if you're writing academic theories because it's concise and airtight, but it's not reality. And so the second piece of it was to try and imbue real insights about how people actually behave into this framework of thinking about a business as a nexus of stakeholders, to try and see if you can find evidence of something that is very different from what the marketplace implies. And there are plenty of examples of companies that are bankrupt and look like basket cases where the employees work really hard to make it work, or a supplier works really hard to make it work, or regulators are happy to help make it work. Lenders are willing to waive covenants to help make it work. And those are the situations that end up working out. And the opposite is true about Schwartz, where there's a company that looks great on the surface, and you scratch below the surface and you find that employees are quitting, suppliers are putting tighter terms, lenders are putting new covenants on loans, all those sorts of things that suggest that the situation is a lot worse than what the market implies. And
like Boeing.
Yeah.
Do we have time just to talk briefly about the American Airlines case? It's a
Sure.
classic case from the 2012-13 time period. Just very briefly, Adrian, just to go over that. It was a classic stakeholder situation where we had a hell of a return early in our run at the firm.
And Tommy has this great saying: when he first started in the business, the guy next to him turned to him and say, "Hey, son, nothing with wheels."
Right. I had worked on the floor of the New York Stock Exchange for about a year, and then moved up to Boston and was working for Alex Brown. And old Freddie C said, "Nothing with wheels, son." So yeah.
So that's rule number one. And rule number two is don't buy equities of bankrupt companies. So we broke both of those rules in American. But the idea originally was that that we thought there was a good chance that American was going to merge with US Air, and that management team at US Air was a spectacular manager of stakeholder relationships. We talked to flight attendants who were flying on legacy America West contracts that in theory were unenforceable if something bad happened, but they totally had confidence that the management team had their back and they were willing to do it. That was a very, very different way of operating compared to how American Airlines had been operated. There were lots of low-hanging fruits on routes and all sorts of things. We did the financial analysis. We thought the stock was undervalued if the merger went through. The merger went through, and the first thing that they did was spray paint over the private parking spots at their headquarters, and all these other things that were, we thought really great for the business. And then all of a sudden, the Justice Department tried to block the deal for anti-competitive concerns. And something we bought for something like 2.5 had gone to 8, I would guess, somewhere around there. It went right back to 2.5, and Tommy called me, or I think I was actually out of the office, which is always seems to be what happens when he called me up and said, "What should we do?" And what was interesting is when the Justice Department tried to block the deal, all of a sudden you had the flight attendant union, the baggage handlers unions, the pilot unions. You had mayors of the cities where US Air operated. You had all these representatives of labor and generally the American public coming out and saying, we want this deal to go through. And ultimately the government works for the people. The Obama administration obviously was very in touch with the people, and so our view was that the deal is going to go through. So we bought more stock. I think the stock went from 250 to 2, and then from then on it turned and ripped and was a huge winner. But if we hadn't had the perspective of the behaviors and the stakeholder relationships, I'm not sure how you would have analyzed that situation.
Right. It's a great example, isn't it? And I know you guys have worked on that with steel, Cleveland Cliffs, and names like that.
It didn't work at Cleveland Cliffs.
I know, but still, it's a way of looking at things rather than just a financial model.
Correct.
Yeah.
It's an overlay.
Yeah, some of the cyclical names that we've been in over the years, including Intero, we're not gonna forget to sell, Kieran, okay, on the next move up, but, we've not been great.
And maybe to wrap up, the last thing I'd love to know is, I encounter a lot of investors who don't know how to categorize you guys, and how that's affected how investors look at you. But it doesn't seem like you really care. I mean, you're putting up good returns, and it's a lot of your own capital. And but what do you think that investors don't get, and they should?
Well, I think one thing we do very little marketing, and so we're grateful for people. Most of our investors are inbounds, and we would like to raise some more money. I'll just say that. And I think that once we sit down and in front of people, we've had some great investors over the years, including you, that are experienced professionals, that some of the best and some of the highest profile names out there put some dough with us, and we appreciate that, and think I don't know what else to say about that. What would you say, Adrian?
Yeah, I think you're right, Kieran. I think we don't really care. We hope our numbers, are good enough and continue to be good, and that sort of speaks for itself. But for better or worse, the industry is, to borrow a term from mathematics and biology and sociology, this idea of isomorphic. When things are successful, there tend to be groups of entities that sort of copy the successful thing, and people forget that in this industry, the all-time, A.W. Jones was a sociologist and a journalist. Julian Robertson lived in New Zealand and was writing a book. And you've got all these great firms historically, Farallon, all these other guys. They didn't fit in, neatly into any kind of a box in there to either. And I'm not here to say that we are anything close to those guys.
Right.
But the idea is that if you love investing, which we do, and you love the work every day and you have fun, and you're just looking for things that you think have, asymmetric return, properties, then it's sort of like, who cares what bucket you fit into? Now, I don't want to be dismissive of people thinking about that. I will say that we do offer a lot of diversification if that's something that floats your boat. And you probably won't see a lot of our names in your other portfolios. But, I think the essence of it, Kieran, is like, I'm not sure what we are, how we fit into a box cleanly, but maybe I think that might be a good thing.
God bless. I agree with that. Fellas, really appreciate your time today. Great discussion. Did a good job, and let's keep talking in the future. So thanks for doing this.
Thank you for supporting the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.